So, we've said that management accounting is the process of providing information to management to assist them with running the business. What we want to think about now is what kind of activities do management engage in the course of running the business. Broadly speaking, management activities can be split into 3 different categories. Planning activities, so looking ahead to see what do we think is going to happen in the coming year. Decision-making activities, so considering what direction do we think the business is going to go in the future. Are we going to launch any new products? Are we going to discontinue any of our existing products? And finally, the third activity is control. So looking at how well is our organisation meeting its objectives? To what extent are we sticking to the plan which was originally set out? So our 3 different management activities then: planning, a key part of the planning process we are going to see within the F2 syllabus is budgets. So at the start of the year, thinking about what do we think our costs will be for the coming year? What do we think our sales revenue is going to be for the coming year? How many employees do we need to achieve our targets? And so on. They are all planning activities. Second, we said, was decision-making. So, for example, deciding to launch a new product or discontinue an existing product. If management are making decisions like this, then they would need to think about the costs and revenues associated with that particular decision. And our third activity, something called variances. This is a key control activity. And when we look at variance, we are going to see that this is just comparing our actual results to the planned costs and revenues. So, they are our 3 key management activities. Now, we're talking about management within an organisation as if all management are the same. But I think we know that there are different levels or tiers of management within an organisation. And depending on which level of management we're looking at, they are going to have different information needs. So first we'll consider what are the different levels of management within an organisation and what kind of information would they be looking for to assist them in their respective roles. So our management within an organisation can be split into 3 different levels. At the very top of our pyramid, we've got our strategic level management. If we're looking at strategic level management, we are really talking about the directors and senior management within the organisation. These are the people running the company at its highest level, so they are thinking about the company's longer term growth and future. So when we're thinking about what kind of information they would be looking for, it would be long-term. Long-term information and decision-making associated with that. When I say long-term, I mean greater than 1 year. So they might be considering to what extent do we think our company is going to grow over the next perhaps 3 years. Our next level down, just below strategic, is our tactical management. This would be our middle management. Now, who middle management are, it depends on the organisation, but perhaps we're thinking about here departmental heads and so on, or divisional managers perhaps. Middle management, the time frame which is going to be considered by middle management would be perhaps short to medium term. So that could be anything from weekly information up to 1 year. And finally, we've got our operational level management. This is our junior management. So junior management, and perhaps factory supervisors, team leaders, and so on. They would be part of the junior management team, and when they're looking at information, it would be with a short-term view. So daily and weekly productivity reports, for example. So our time frame then would be short-term, perhaps daily or weekly reports. Okay, so we've looked at our management activities and the different layers of management within an organisation. The final thing we're going to look at in this session is organisations themselves and how companies can be divided up in order to provide better control over the organisation as a whole. Let's consider the following example. So I've mentioned that a key management activity is control, looking at have we achieved our targets for the year. Let's say for a particular company at the start of the year when they're doing their budgeting process, they calculate or estimate that total costs for the year for the company will be £1 million. At the end of the year, they look at their actual results to see, well, how much money did we actually spend? What were our real costs? And they discover that actual costs for the year were £2 million. So you can see there's quite a large difference between the expected or planned results of £1 million costs and the actual results of £2 million in costs. Now, it might be very difficult for a director sitting at the top of the pyramid to look at this large difference between planned and actual results and understand what has caused the difference. Any company is going to incur a wide range of costs across a number of different departments, so perhaps just looking at that total figure of 1 million versus 2 million is not particularly useful. Most organisations will be split in to a number of different sections and areas, each responsible for managing their own costs and or revenues. So at the end of the year, if someone's looking at a large difference, like in our example, they can identify, well, which particular areas of the business did not achieve their targets. So to help us understand how an organisation might divide themselves up like this, we need to look at a bit of terminology. So, within an organisation then, the first distinction we might make is to split the organisation up into a number of different cost centres. Now, a cost centre is a department, function, or any part of the organisation for which costs can be ascertained. So, for example, if we look at LSBF as a college, and perhaps their ACCA department and their CIMA department would each be distinct cost centres. So we can calculate what is the total cost of running ACCA courses. What is the total cost of running CIMA cost centres? So each function is a distinct cost centre. The manager of a cost centre will be responsible for the costs associated with running that particular department or function. We might also have a number of different revenue centres. Unsurprisingly, the manager of a revenue centre is responsible for the revenues generated by that department or function. A revenue centre is usually going to be something like a sales department. So for a sales department, rather than them having a cost target, they will have a revenue target. So they are expected to earn the company a certain amount of revenue per week and per month and so on. The manager of that sales department is responsible for ensuring that the revenue centre meets that target. Now we could go a level up and we would have a profit centre. The manager of a profit centre is responsible for both the costs and the revenues of that particular area. So what we're looking at here is perhaps a division within the business. So a particular division who is responsible for the revenues earned by that particular area and the costs associated with it. So perhaps the LSBF London campus might be a profit centre. The London campus is responsible for both the costs and the revenues earned by this campus. If we go another step up, we would have what we call an investment centre. An investment centre manager is responsible for the costs, the revenues, and the capital expenditure. So what I mean here is that the manager of an investment centre will be responsible for the reinvestment back into the business. So for example, if we choose to invest in a new building, a new asset for the company, that would be capital expenditure, and an investment centre manager would have that responsibility. So this is how we might break up our organisation into distinct areas of responsibility. Just one final thing before we move on. If we go back to the very lowest level, where we split up into cost and revenue centres, we may go a step below that and define a cost unit. Now, this is an important concept for the F2 syllabus. A cost unit is a unit of product or service for which costs can be ascertained. Very important concept within management accounting, our cost unit. So let's say, for example, we are a company that manufactures and sells tables. Then our cost unit is going to be simply one table. And an important part of our management accounting system would be to understand how much does it cost us to produce one single table, which is the cost of one cost unit. Now, as we go through, we're going to see why this is important, but if we just think about it sensibly, if you produce and sell tables, why is it important that you understand how much it costs you to produce a table? Well, I would imagine a key reason why it's important is because if you don't know how much it costs you to produce your product, how do you know how much to charge your customers for it? So selling price. We need to know the cost of each of our cost units so that we can establish a selling price.